Fresh and Fit Money Clips. Unlock the secret to minimizing taxes with Myron Fresh on the Fresh and Fit Podcast Money Monday show. Joined by special guest CPA Steve Colon, this exclusive episode reveals 7 strategic ways to legally reduce your tax burden in the current year. Gain invaluable insight, expert tips, and actionable steps to keep more of your hard-earned money. Don't miss out. Tune in now and learn how to navigate the tax landscape with Myron Fresh and CPA Steve Colon on the Fresh and Fit Podcast Money Monday show.
We're going to go over 7 ways, guys, to lower your tax liability. I see here that there's a different array of types, whether you're involved in real estate, you're a business owner, you're just a regular person, and you might just want to bring down your tax liability. And we're going to count down from 7 to 1. So the first one I see here, Steve, that you got is the 1031 exchange for real estate. Can we go over that a little bit?
Absolutely. So this is a huge one. And again, the reason why I have this as number 7 on the list is because your listeners, I know not everybody's involved with real estate, but maybe, a lot of them want to be.
Yeah.
So this kind of goes to those that want to be involved in real estate, or maybe they are involved with real estate. So if you have a property and you want to sell that property, you have to face the capital gains tax. Mm-hmm. So what Congress did, and this is an interesting one, and everybody thinks,
can you tell them real quick what a capital gains tax is?
Okay, yes. So if I buy a property for $100,000 and 3 years from now I go and sell it because it appreciates in value, I sell it for $300,000, I have hypothetically a $200,000 capital gain.
Yeah.
So I'll have to pay tax on that. Since I held it for more than a year, it's going to be around 20%. Mm-hmm. So I'd have to expect to pay about $60,000 or $40,000 for that $200,000 gain.
Wow.
So what I can do, and what Congress did, and you got to remember, Congress passed this many years ago, mm-hmm. because real estate is a huge part of the economy. They understand this. The guys that are making these laws, they own real estate themselves. They don't want to shoot themselves in the foot. So they have multi-million-dollar properties that they want to sell. So they want the economy of real estate, because it's such a huge part of the economy, to keep moving, and they want property, they want buyers and sellers to be in the market to stimulate the market. So by stifling owners that want to sell their property from hitting them with high capital gains tax, they understand that that's going to stifle the market. Mm-hmm. That people will wind up holding on to these properties and not selling them, mm-hmm. and doing other things that they shouldn't be doing, so they're not true arm's length transactions. So they put the 1031 exchange, and what that means is basically a like-kind exchange. There used to be a time when you could do this to like businesses and other different types of assets, but now they just limited it to real estate because it's such a big part of the segment of the economy. So a like-kind exchange means that you could take a property, mm-hmm. like the ones that you're buying now. Mm-hmm. Let's say one of those properties, you just want to unload it. You're having problems with it. Maybe there's problem tenants. Maybe there's something coming in the neighborhood. Or you see something else you want to purchase. You could liquidate that property, sell it, mm-hmm. as long as you go and take the money, the proceeds for that, mm-hmm. and you invest it into another property that's of equal or greater value. You could defer the entire tax on that and not pay anything on it.
Okay.
All you have to do is contact an intermediary, typically a lawyer that handles those types of transactions, identify that property, say, hey, I'm going to sell this property on 8th Avenue. Mm-hmm. I'm going to buy this property on 11th Avenue. This one I'm selling for $400,000. Mm-hmm. The one I'm buying is $500,000, so it's greater value. Mm-hmm. So hence, I'm not going to pay any tax on that property. I'm going to purchase this property. You go to your lawyer. He fills out the paperwork. Now, there's a couple of things on this one, which sometimes you don't have that opportunity to get that replacement property. Mm-hmm. So, and then you also have the time limit on it. Yeah, you have 45 days in which to identify 3 replacement properties that qualify, and then you have 180 days in which to close on that new one.
Yeah.
And then the thing is, that money has to go into escrow. Sit there until you close on the other one. And then,
can you explain to the people what an escrow account is?
So escrow is basically when you go into like your attorney, and then so the proceeds when you sell your property, that money doesn't go into your bank account. It goes into the attorney's bank account. He has an escrow account that's bonded, of course, and it sits there until you get ready to close on your new property, and then the money comes out of
Keeps things honest in the real estate game, guys.
And
the money doesn't ever come to you, actually. It always goes to a middleman almost that holds the money on both parties so that, you know, it can ensure it goes where it's supposed to go. You know, you don't rip people off, etc.
Yeah, perfect. Yeah, and it's a paper trail, too, for the IRS. So these are handled in a very specific way. A lot of times, you know, you got to be careful with that because you don't want, sometimes people are pressured because they don't want to pay the taxes, and then they're kind of locking themselves into buying a property that maybe they're not really in love with and they don't want to, don't want to buy. So sometimes, in those cases, I've had clients who are like, I can't find anything because it's been a very competitive market recently. It
has been. So I guess we'll go into number 6 now. The sixth way, guys, and again, today's episode is the top 7 ways to lower your tax liability. We have another real estate one here, guys, which this one is a bit more advanced, and I utilize this quite a bit. But if you know how to use it correctly, this is going to be huge. It is called cost segregation, guys, okay? Steve, take it away.
Huge. So basically, cost segregation. So when you buy a property, let's say it's a rental real estate property. I buy a property for $400,000, and what most CPAs or tax professionals might do is just depreciate that property over 27 and a half years.
Yep.
Let's make it easy math. Let's say it's 30 years, right?
Okay.
That's a long time. So you're only taking 1/30th of that $400,000 and taking that as an expense.
Can you explain to them real quick what depreciation is? Because a lot of people get confused about it. They're like, what is depreciation? How does this help me on my taxes? I don't understand it.
So basically, the IRS has a method of assigning a useful life to everything that you buy, every asset that you buy that's tangible, and even intangible stuff too as well. They assign it a useful life. So for instance, this table would be 5 years. This equipment could be 7 years. Computer equipment is typically 5 years. A car, 5 years. Well, they say a house is 27 and a half years, right? The problem is not everything in the house that you buy is going to last 27 and a half years. For instance, the carpet, the appliances, sometimes the windows, the roof has got to be replaced, every maybe 10 years. So what you do is you take that property, and instead of just giving it all $400,000 and dividing it by 27 and a half years and taking that little amount of depreciation, you take that and you break it up. So let's say I break it up, and for simple math purposes, I break it up into $400,000 component pieces. I segregate it into 400. So 100, 100, 100, and 100. I got 400,000, and I assign maybe 5 years to 100,000, 7 years to another 100,000, and 15 years to the other 100,000, and then 27 to other 100. You can see in that scenario, I'm accelerating my depreciation, so my total amount of depreciation is going to be much greater than just keeping it at the 27 and a half years. Yeah. So you can get a huge deduction, and that's what we did with your properties as well. We broke those properties up, and we did it 2 years too as well. And we did it's called a cost segregation study. So you go through and you kind of pick out the component pieces of the property that you can depreciate quicker.
Yeah. So what it allows you guys to do is basically you're able to more aggressively write off parts of the home that are non-structural.
Number 5.
We're on to number 5 now, guys. Again, this is the top 7 ways to lower your tax liability. Section 179 and bonus depreciation. What is that?
So, Section 179 is an expense deduction, basically for business owners that buy equipment. So you can buy up to close like $1.2 million worth of equipment, and you can write that off 100% in the first year. So it's a huge deduction. Wow. So this is getting back into the tax planning stuff. So a lot of my clients get down to this area and they project forward to see what their profitability is going to be, and maybe potentially what their tax bill is going to be, and maybe they got some money built up in their cash, and they want to go out and buy a vehicle or something like that, trade up or trade in some of their business vehicles. So a lot of times we'll do that at this time of year, or maybe they want to buy some equipment, maybe they need some equipment. So for some, like for instance, for some of my medical practices, they buy medical equipment that's pretty expensive, and then if they're in a position to do that, rather than pay a big tax bill, they can get their taxes way down, and we can write the whole thing off. So I mean, the only stipulation on that is you got to use the property for 50% more for business use, and you have it's qualified as a small business, so you can't purchase more than $4 million worth of equipment to qualify for the Section 179.
Now we are to number 4. Okay.
Yeah.
401k Roth versus traditional W-2 and business solo.
So for retirement savings, basically, and not everybody's a big proponent of retirement savings. I know everybody says take your money, be in charge of it, invest it in your own assets instead. But not everybody wants to invest in their own assets. Not everybody's going to be a real estate owner. Not everybody's going to be a business owner. Some people have a good job, a good career, and they can see their future in that, and they're going to make a lot of money, and they just want to put money away. So if that's the case, I would definitely, take advantage of the IRAs. But the Roth versus the traditional. The Roth means that today you put the money away, and I don't get a tax deduction for it right now. When I go to pull the money out, I get the tax deduction for it. The traditional, basically, I get the tax deduction now for it, and I let it grow tax-free. And then when I go to pull it out, when I'm of retirement age, then I'm going to get taxed on it.
Top three now. Top three. The top three. The HSA plan.
Yeah, so that's a health savings account. And whether you're a W-2 wage earner or you're a business owner, you should probably take advantage of it. So basically, that's a health savings account. You can put about $4,000 per person away, and you can put the money in and get the deduction on your tax return. You can let the money grow in an account. You can invest it in anything that you want. It doesn't have to be anything specific. It's basically you self-direct it the way you see fit. Some people have taken the money and invested it into like real estate too as well. And then when you pull the money out, you don't get taxed on it, but you have to spend it on qualified medical expenses. But you can let the money grow in there. But you could set it up for yourself, for your kids in the future. We're gonna have kids or whatever. So I mean, I like it because it applies to everybody, and you're a business owner. You can put about $4,000 away per year.
Can you borrow against it?
No, that's basically you're just going to use it on qualified medical expenses.
Got it. All right, cool.
Number two.
So now we're going into the top two here, guys. Okay, so
Round two.
So this is huge, and this is for my business owners. Get yourself a qualified bookkeeper.
Bam.
I mean, that is, I can't stress that enough. It makes everybody's life easier. It gives you information.
I just got one, pretty much.
Yeah.
With
It gives you information throughout the year to make decisions on your business, and you want somebody that's a full charge bookkeeper that knows, get hooked up with some program online, whether it's Xero or it's QuickBooks Online, that is proficient in that knows how to take your bank account, link it to get all the download for the transactions and bucket those and code those transactions. So you have, they reconcile the bank statement every month or maybe every quarter. You should at least every quarter, every 3 months have something financial wise where you have a profit and loss and you know exactly where you stand in your business so you can make decisions. It's worth its weight in gold, because this way not only do you have the information all year, but when you go see your tax professional at the end of the year, everything's done. It makes their life easier, makes your life easier. You know where you stand. You can get better tax planning. So definitely just spend the money to do that.
Number one, fellas.
So number one, last but not least, get the right CPA or tax professional.
Ooh.
CPA or EA. And you want somebody that's accessible, that's reasonable in fees, that has industry-specific knowledge. So ask, the people in your industry, whatever if you're in medical, find out who they're using in your area and link up with them.